In this video, we will discuss bond valuation. The value of a bond, or the present value of a bond, is the discounted sum of all future cash flows. For bonds, they have a future value, face value, or maturity value, commonly assumed to be $1,000, and that is paid at the maturity date in of the bond. They also get an annual, semi-annual, quarterly payment. In this case, we assume annually a payment each year, all the way up to n years. Each of these payments is discounted by the interest rate I, the first payment by 1 plus the interest rate, the second payment by 1 plus the interest rate squared, the third payment by 1 plus the interest rate cubed, etc., all the way up to the face value payment at the end of the bond's life. That same interest rate can be expressed as the payment over the present value plus the change in payment given one period, commonly a year, over the present value, also known as the current yield of the bond, and the capital gains yield of the bond. The current yield is positive, the capital gains yield can be positive or negative. We will look at examples of how our bond's value changes as a function of both interest rate, number of years to maturity, and coupon payments. In our first example, we will look at an annual bond with 10 years to maturity, an annual payment of $50, and a future or face value of $1,000. The value of the bond is the discounted sum again of all future payments. In Excel, this can be expressed as PV of first A13, the interest rate, B3, the number of years to maturity, B4, the payment of the bond, and B5, the final face value of the bond. The negative is because the convention of PV is to make a payment into a system, as in purchasing a bond, negative, and it's more convenient in this case to make all the bond values positive. First, for an interest rate of 0, we would just sum up the 1,000 face value plus 10 times 50, or 500, to get 1,500, since there is actually no discounting that takes place. As we move down this column and interest rates change to 1%, 2%, 3%, etc., then the interest rate in here changes, which is the same thing as increasing the discounted interest rate in our equation. So as interest rates go up, the value of the bond goes down. Since our coupon is 50, the coupon rate is 5%, and when the interest rate or discount rate is 5, our bond will be at par, or $1,000. Par means the face value and the present value are the same. So we can see as interest rates increase, the value of the bond goes down. As interest rates go to 0, then the value of the bond is just the sum of all of the cash flows. As another example, we will look at changing not the interest rate, but changing the number of years to maturity. So here, the number of years to maturity was a constant, interest rate gradually increased. In our second example, we will keep an interest rate constant at 7%, again a face value of 1,000, and now we will gradually decrease the number of years to maturity. We will look at 3 different bonds, one bond with a coupon rate of 5%, one bond with a coupon rate of 7%, or a coupon payment of 70, and one bond with a coupon rate of 10%, or a payment of $100. So since our discount rate is 7%, our bond with a coupon rate of 7%, or a $70 payment, will be a value of $1,000 no matter the number of years to maturity. Our bond with a coupon payment of $50, on the other hand, is going to start out with a value below par because the interest rate demanded by the market of 7% is higher than the coupon rate of 5%. Our bond with a coupon rate of 10%, or a payment of $100, will start out at a premium because the interest rate demanded by the market, 7, is less than is actually being paid 10. As we approach maturity and these payments take place, then each of these bonds must gradually move towards the face value. So the discount bond will gradually increase in value, the premium bond will gradually decrease in value, and then finally on the day of maturity, all of the bonds will be worth $1,000. You can see this here. Our 7% bond always stays at 1,000. Our 10% bond has a capital loss every year, gradually decreasing to 1,000, and our 5% bond has a capital gain every year, gradually increasing to 1,000 until they're all worth 1,000 on the day of maturity. So if we look at our equation here, the rate of return on all three of these bonds is going to be the same, 7%. In the case of the par bond, there is only going to be a current yield of 7%, no capital gain or loss. In the case of the 5% bond, you will have a gradual capital gain to make up for the fact that the current yield is below 7%. And for the 10% bond, you will have a negative capital loss every year that when added to the 10% coupon will again make an I of 7%. I thank you for watching this video.